Now for his take on the market, it's good evening again to Scott Phillips from Motley. Now, Scott, Chris mentioned the CBA profits, but there was some interesting research from Macquarie on the premium multiples its shares are trading compared to other banks.
Yeah, Tomo, good evening. That's a really good point because, as Chris mentioned, really bumper headline profit. And as Matt Common effectively said, that does to some degree over-egg the pudding. Their underlying earnings were only up 1.7%, which is much more anemic and not what the bank wants us to talk about. On the flip side, as you say, Macquarie also saying CBA's price earnings multiple is somewhere between a third and a half more expensive than the other big three of the big four banks. And if you think about that, you've got to believe CBA is going to do a lot better for a long time to justify that multiple.
OK, now IAG was another to report. The insurer posting a big loss but squeezing out a small dividend.
Yeah, the dividend was probably generous and probably, I'm sure, a lot of shareholders happy about it, at least in the short term. When you lose $500 million, paying a dividend can be sometimes a little bit generous, but we'll see over time. The key thing here, of course, was IAG had written business continuity policies that paid out if there were business disruptions. Of course, we know we've been through COVID for the last 18 months. The insurers as a group tried to argue that COVID shouldn't be covered by that policy. Thus far, at least, the courts have said, no, you've got to pay out. And that really hurt IAG to the tune of more than $1 billion in the last financial year.
It's got a big result for Mineral Resources. It's more than doubled its dividend and earnings up close to 150%.
This is an astonishing result, Tomo. One of those things when the market fills your sails, and not the share market here, but the market you're actually selling into, then you just got to sail as fast and as far as you can. Mineral Resources had a bumper year because they increased output, in some cases by up to a quarter. And of course, we know iron ore prices have gone through the roof recently, which really has, as I said, filled the sales of the company. Now, shares were pretty much flat today, and that is to some degree part of the story that the market already knew what the output was going to look like. They knew what the price was going to be, and so the maths was relatively straightforward. Still, you'd be a pretty happy Mineral Resources shareholder today.
Tomorrow it's Telstra's turn. Its February result was a fall in profits. What do analysts expect for the full year?
Probably another one of the same, Tomo. Some of the big analyst firms and brokerage houses are expecting somewhere up to a 10% fall in earnings. In fact, that's a pretty consensus number. The dividend is expected to hold steady at 8 cents a share. That should give the company something like a 4.2% dividend yield at the current price. And of course, Telstra shares are up 25% over the last 12 months. So it's been a pretty good year for Telstra shareholders. The challenge for Telstra, of course, is to find a way to grow because you can't keep paying dividends like IAG if your business keeps declining. At least you can't pay them at the same level. So Telstra's got to find growth somewhere. It probably won't have come this last half.
And finally, Scott, an important night for Wall Street with the US inflation figures to be released.
Yeah, and a nervous Wall Street right now, Tomo, as has been the case almost all week. The futures are pretty much dead flat. The inflation numbers matter a lot because they are the precursor to what the US Federal Reserve, their version of our RBA, might do in interest rates there. That, of course, impacts not only householders with mortgages, but business costs for their own debts. That's the big one. If inflation is up and going higher, there's a very, very good chance the US Fed moves interest rates sooner rather than later, and that makes everything a bit more expensive.
All right, Scotty. Thank you. Scott Phillips.